Good afternoon, everyone. Market's pretty interesting as usual. It normally is, but now we're in this trading range, and it's pretty volatile. But it doesn't really go anywhere. So we'll discuss the market overall. Just a little bit of background on our company. I started this back in about 34 years ago as a derivatives research firm. We were making recommendations, selling data, etc. We expanded into money management because we made several good calls around the financial crisis in 2008. So we're both a RIA and a CTA, running pretty much one option strategy, although we do have just some modifications and that sort of thing. And then we also have option education seminars like this, and we have a mentoring division as well. I'm going to come back to this later, but I do want you to know that the PDFs of this webinar are available at this website right here, optionstrategist.com/tigershark. And I have posted them up there right now in case you wanted to grab one. The two of them, one is in color, one's in grayscale. All right, so let's get started. If you've heard me talk before, you know that I have four main indicators we look at, although we will look at some other nuances, including some seasonal things at the end of the talk today. But first is the chart of the S&P 500. That's the most important thing. We recently had a situation where the S&P was, not bullish. All the other indicators were, and it turned out that, S&P was not able to sustain the breakout. So the S&P chart is really the main thing we have to not only look at, but emulate as well. Equity-only put-call ratios, those are useful. We'll look at the broad market as well as some individual stocks there. Market breadth, that's one of our best indicators. And then, of course, volatility indices, things having to do with VIX. So there's a general rule of thumb that oversold does not mean buy. Markets can go down a lot farther than you might think. And so if it's oversold, it can continue to be oversold for quite some time. And there's a corollary. Overbought does not mean sell either. So I wouldn't say right now we have too much in the way of overbought or oversold, but I will show you some examples as we go through the indicators. So here's the long-term chart. The bear market of 2022 is gone. It was more than 2 years ago, so it ended in October of 2022. We went into a modestly sloped bull market at that time, and then since then we've really been on tear, really since October of 23, when we finished that modest correction. Right here, a 10% correction. Since then, we've been off on a pretty steep angle for, a year and 4 months or so. So at the top right here, you can see that we're in this trading range, and we've more or less been in it since November. The thing about that trading range is that we tried to break out right here once, and I tried to break down right here once, and both of those failed. So we're pretty much inside this 5860 to 6100 trading range, and we'll look at it a little bit closer. Here's a 1-year chart. Same thing. You can see the trading range. That circle there is a gap. That's the only gap right now that's left on the chart, although we have one now today, as well as we gapped down. We didn't gap down a lot, but we did gap down today some here. But that the S&P usually fills these gaps. Not every gap. You can go back and see there's a couple on there that never did get filled. But most of the time they do get filled. And what's sort of interesting is when they get filled, they can be meaningful. So this gap here that happened at the beginning of November, this one right here, was actually what we call an island reversal, because it left this little island, gap down, traded, and gap back up again. And the most recent correction that we had, which ended in the middle of January, traded right down to the edge of the gap. That's what the pink line is there, and then bounced. So the gaps are significant. If this one that's right there that's still open is the bottom of that gap is actually the bottom of the trading range as well. So wouldn't be surprised to see if we traded down there, we got another pretty good bounce after filling the gap. But right now that's still just a sideways chart. So we're not really considering this an S&P chart where you'd want to hold a core position. A lot of times we'll hold a core bullish or a core bearish position, but we're not doing that right now. The false breakouts on both ends were pretty, I would say, destructive. In both cases, the breakout lasted for 2 days before reversing back inside the trading range, which is, sometimes you get a 1-day fake breakout. That's okay. 2 days false breakout is pretty unusual. You get 2 of them back to back. Really indicates this market is not able to get momentum going. But I do still think that once we break out of this trading range, you'll have a good, strong momentum move of probably 200 or 300 S&P points in whichever direction that occurs. Another thing we do with the S&P chart is we draw what I call modified Bollinger Bands on it. When John Bollinger invented Bollinger Bands, he used as the definition of realized volatility, he used the standard deviation of daily closing prices, which certainly sounds like a reasonable definition. But in reality, the Black-Scholes model and other mathematical models use a slightly different definition. It's the standard deviation of daily percentage price changes. And so that's what we use because that gives us a realized volatility that's in line with implied volatility coming out of the Black-Scholes model. And of course, since we're in the option business, we need to have those two line up and make some sense when you're trying to compare the two of them. So what we do with the modified Bollinger Bands, though, is we look for the market to move above or below 4 standard deviations away from the 20-day moving average, which is what a Bollinger Band is, a band around the 20-day moving average, and then to move back inside. So that gives us a signal. And in the past, I mean, this has always been a pretty successful system, but we were getting a lot of false signals. So we put a separate criterion on it to require even more confirmation on a signal. And so that's what we call MVB, which is McMillan Volatility Band. So here's the current S&P chart going back 1 year. And these letters on here are the signals. So you can see, for example, let's just take this one right here. This top band right here is +4 standard deviations. And then the band inside it is +3 standard deviations. So we moved outside the band and inside, we got a sell signal right there. And our objective is to have it go down and touch the lower band, which it did down here. So that was a successful sell signal. It gave a buy signal then right after that. And that buy signal, even though the market's moved a lot higher since then, and we made good money off that buy signal, and we rolled it up the options several times and all of that, it's never touched the upper band nor the lower one since then. It's really a very long period of time for that to be the case. But what's happening is realized volatility is fairly high right now, so that the bands are far away from the 20-day moving average. And even though we're in this trading range right now, it's a volatile range. And so that keeps the bands pretty far apart. So you can see right now the upper band is around 6,200, just above it, and the lower band is all the way down at 5,850. That's a pretty wide distance if you say compared to, say, the left side of the chart, for example, where the bands were, maybe just 200 points apart. Now they're 350 points apart, or even more. So on this chart, the red letters indicate successful signals. The blue one was a unsuccessful one. That was they moved above the band and then back down lower and gave us a sell signal, but never reached the bottom band and eventually went back outside, and that stops us out. So all of these systems, or all of these indicators, we have systems that we trade, rules that we trade for each system. So the last buy signal, or last signal, was that buy signal back in August. I mean, we really don't have a position based on that anymore. It's rolled a few times and then eventually we just closed it out. But technically, its target is still that upper band. And as I said, we haven't touched either band since last August. We have a service that runs through TradingView that you can see these bands on anything, any stock index or futures chart, and this is the S&P. So this has a little red arrows and green arrows for buys and sells. It doesn't have these circles. I put those on there, but those are the four signals that were just on that previous chart. So the buy down here, the failed sell, the working sell, and then the buy that's technically still in effect. But if you look back over the rest of the chart, you'll see that it's unusual for it to go this long without a signal, although it did have a period of time, it did have a period of time where it was not giving a signal really in this area right there. That's not as long as we are right now, but close to it. So then you can see prior to that, there were quite a few signals. So again, this is something we follow in all of our newsletters, and it has a strong track record. If you're interested, we have a subscription service of that where we send out every day a list of stocks or futures or indices that are giving new signals or about to give new signals. So let's move on to the second indicator, put-call ratios. Put-call ratios were invented as an indicator by Marty Zweig back in the 1950s when he used to get the option volume out of the ads that ran in Barron's on Sundays. The put and call dealers of those days would advertise that they traded so many calls and puts. And he realized it was a contrary indicator after a while. If there were a lot of calls trading, the market would go down. If there were a lot of puts trading, the market would go up. So we'll look at that. But for the broad market, we use the equity-only put-call ratio, which is all stock options that trade. So there's millions of those these days. Back when Marty was doing it, a few hundred, maybe. But now, this is an indicator that has worked for us pretty well, and I'll show you the charts on that as well. So the theory, the contrary theory that Marty came up with is too much put buying is bullish for the market, too much call buying is bearish for the market. But of course, measuring what's too much and deriving signals out of it and everything is a little bit more complicated. But we've been able to do that. So let's take this example. Suppose it's IBM. At the end of the day, we sum up the volume of puts traded in IBM, separately sum up the volume of the calls, divide the two, and that's the put-call ratio. So the put-call ratio moves opposite to the stock price. So if the volume of puts is increasing, the ratio will go higher because puts is in the numerator of the fraction. But when is the volume of puts likely to increase? Well, that's when the stock is going lower, right? People are chasing it down, buying puts. So the ratio and the stock price move opposite to each other. Same thing with calls. Calls are in the denominator. So when the denominator of a fraction increases, the fraction drops in value. And of course, when is there likely to be heavy call volume, making that ratio drop? Well, that's when the stock is going up. So again, same thing. So we keep a moving average 21 days just in case there's something to Fibonacci. And we publish on our website every day over 1,600 put-call ratio charts, some really probably more than 2,000 most days. And we publish both the stock price and the stock and the ratio so that you can compare the two, because it should look something like this. There should be this symmetry. So let's suppose the stock is dropping in price, and as that's happening, people are buying puts, forcing the put-call ratio higher. So during the trend, the public is right or whatever, but eventually the put-call ratio peaks out and forms a local maximum. That local maximum on the put-call ratio is a buy signal for the stock. So now the stock starts to go up, move over to the left side. The stock's still going up. And as the stock is going up, people are buying calls, forcing the ratio lower and lower. Eventually, the ratio forms a local minimum, and that is a sell signal for the stock. So that's the theory. And when I'm looking at a put call ratio chart, I really want to see not only the symmetry, it's not that perfect, of course, but I also want to see some success from previous signals. This is not a current chart, but on top is the S&P 500 index, and on the bottom is that equity-only put-call ratio that I talked about, and you can see the inverse symmetry there. And so that's why we use the equity-only put-call ratio to predict the broad stock market. So here's the current ratio. And this is what we call a standard ratio. I mean, we're just looking at the volume of calls versus the volume of puts. So in this case, you can see we've got some local maximum, local minimum along the way. I mean, this, the one we had here in last August here, nice local maximum. That's a buy signal, as you saw, and so we had a pretty good market going there. Again, red letters are successful signals, blue letters are not. So this market got very, I would say overbought down here at the end of middle of December, and gave us a sell signal, and the market did go down for a little while. This ratio didn't go up very much, and now it's kind of just moving sideways right here. So technically, that little peak there has lasted for more than 10 days, so that makes it a buy signal. But I put a small B on it because, first of all, it's very low on the chart. You would like to see buy signals coming up from this area, a more oversold area, more pessimism being shown by the public. Here we're still seeing a fair amount of optimism in this fact. This number right here was the lowest since just before the last bear market started back in 2022. It was, traded down there in November 21. But you can't jump to the conclusion that another bear market's about to start out. I'll show you a longer term chart in a minute. But in this particular case, I'm not really getting what I consider to be a signal out of this thing. It's moving sideways right now. Yesterday it moved down. Today with the market down, it probably moves back up. So we're just not really seeing a lot. Now, as computers came along, we were able to calculate a second ratio, slightly different ratio. I'm going to take into account the options price as well as the volume. So for each option we multiply at the end of the day, its price times the volume that traded that day. And you could do that on a tick-by-tick basis, but we tried that. It was expensive and didn't really give us any better results than just doing it this way. So again, let's say it's IBM. We do that calculation for every option. We sum up those dollar volumes for the puts. Separately, we sum up the dollar volumes for the calls, divide the two, and that's your weighted put call ratio or dollar weighted put call ratio. And now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So it's often very similar, but usually there's a little bit more extreme to it. So for example, you can see last August, again, it was a good buy signal, local maximum on the chart, and that same good buy signal. But at the current time, it's a little bit different. You can see this one after that sell signal in December, which came also at a very low level on the chart, right? Lowest level since 2021, November 2021. This one moves pretty strongly higher, but you got up to the middle of the chart, rolled over, and now it's declining. So this one is still on a buy signal. And so whatever's going on in general, there's not a lot of dollars being spent on puts. That I can tell you right from just looking at this. So the two are somewhat mixed at the current time, but these sell signals from December are rolling or have rolled over to buy signals. And in both cases, we noted that they were as low as they were in late 2021. That doesn't necessarily mean, though, that that's a really extremely overbought or over optimistic point. Here's a 10-year chart. And so you can see where we are right now over on the right-hand side. And yes, it's optimistic. I mean, right in here, this is the exact same chart, standard chart we're just looking at. It's low. And yes, it's just as low as it was in late 2021. But you can see that it got that low all the way back just after the pandemic, really in I think that's about June of 2020. So we came out of the pandemic, which was, of course, a very pessimistic high spike on this chart, and you made a local maximum there buy signal. We came down, we stayed in this extremely optimistic post-pandemic market for quite a while. So right now we're just getting to that level. I mean, we could stay there for a long period of time. So that's why I say, overbought does not mean sell until we actually see the thing, break out and start to move higher, which it did eventually in the beginning of 2022. So what do we trade when we get these signals, McMillan volatility band signal, or these signals here based on put call ratios for the broad market? So we trade SPY options, typically 1 or 2 strikes in the money, and typically, 3 to 4 weeks out of time, sometimes a little less than that. So that kind of an option, slightly in the money with a fairly short time period, is going to have a delta of about 70. In other words, I want the option to perform pretty much exactly like the stock. You could buy a deep in the money option that would perform exactly like the stock, the underlying, but that's not really necessary. You lose your leverage capability that way, and also you're spending a lot more dollars. If we're talking a little bit longer term, maybe a 3 or 6 month purchase, I might do an at the money, but still, again, that's going to have a fairly decently positive delta. I don't want to buy some option that's way out of the money and then be right about where the S&P went and wrong about having owned an option that was just too far on the money to take advantage of that. So on TV, they almost always spread. Every trade they do is a spread, which is not the way that real people trade. But I don't know if that's a legal thing or who knows what. But by spread, I mean a bull spread. So let's say you're bullish on this stock. So you buy a call at this strike, and that's your momentum for owning it, for being bullish. But then you also sell a call at a higher strike. So what happens is you cut your profit potential off by selling that second call. And that's a pretty devastating thing to do to yourself. There's only really one case that justified, and that's if the implied volatility is high. And we have volatility data on our website. Every Saturday we update for free the implied volatility on every stock, index, or futures on any that trades options. So you can see the realize and various periods of realize, as well as the implieds and various percentiles of implied. But the proponents of spreading will often say, well, you're risking less. That's not true. You're whether you buy the bull spread or you buy the call, your broker won't make you pay for the spread in full. You have to put up all the money that the debits of the options require. So you're risking 100% no matter which one you're in. Now, the dollars may be slightly less on a bull spread than a call purchase. So instead of buying, let's say, 5 spreads, maybe you just buy 4 calls. But the advantage of the call purchase is this: if the stock really takes off, then you have a lot of upside. And the thing is, you can see it in the long-term track record of our newsletters, but in my own trading as well. I mean, I've had a lot of big winners that would have never materialized if I made a bull spread out of it instead of just a straight-out call purchase. Now, if you decide to spread, there are a couple of things you can do to mitigate the negative aspects of spreading. One is to widen the difference in the strike. So currently, right now, if we're going to recommend a SPY call expiring near term, less than March 7th, then I wouldn't spread it. But if it's after March 7th, then I would spread the strikes 15 to 18 points apart on the calls, or if I was doing a put spread, even wider, 25 to 30 points. The reason is that out of the money puts on the index, any index, SPY, for example, trade with a much higher implied volatility than out of the money calls. So you can widen the spread. Secondly, you roll if the short strike is hit. So what do I mean by that? So let's say today, the market down a little bit, SPY around 600, you decide to, you wanted to be bullish, so you bought a March 600 call and you sold a March 620 call. And later on, you're fortunate enough to see the SPY trade up to 620. So at that point in time, here's your original spread. This is 620, and this was 600. But now your spread is nearly maxed out. Maybe not quite maxed out, but it's certainly not going to make a whole lot more money after this. So sell that spread, take nearly your whole profit, your max profit, and then replace it by buying the next spread up the line. Buy the March 620 call and sell the March 640 call, and repeat as necessary. Rinse and repeat. So this will keep moving your upside higher. You can take some profits along the way, but it won't just completely cut off your profit potential altogether. Puts it just the opposite. Let's say if you're bearish today, you buy a March 600 put, you sell a March 570 put, and then if SPY trades down to 570, you roll both sides down 30 points. Okay, so individually, we can look at put call ratios too on individual stocks, individual futures, indices, or what have you. So here's a few interesting ones. Now in these, we only trade the extremes. I don't trade the wiggles in the middle. So over here on the left side of the chart, there's a few local maximum minimum, but they're kind of in the middle of that chart. So those we wouldn't trade, but we do trade the ones that are marked there. So there was a sell signal from a very low level there in July, and that worked out pretty well. I think it came in about there. Two buy signals there. The first one was a little premature, but the second one came in well. And now this last one from a very low level on the chart, we just got a new sell signal here. It's 20 on the left side. If you look over there, see the 20. That means only $20 are being spent on puts for every $100 being spent on calls. So that's a very optimistic dollar-weighted put call ratio. So 5 times as many dollars are being spent on calls as puts. So that's a sell signal, and so this just came out the other day. So we're buying puts on that. Here's another one. This just gave us a buy signal yesterday. You can see the most recent local maximum there on the upper right, the green B. New signals I mark as green, and you can see the put call ratio made a local maximum there. But there was some resistance here, but now we've broken out above that. That's actually at 69. So we're just a bit higher than that right now, and that's a brand new one also. This is a couple weeks old. It's the yen. FXY is the ETF symbol for the yen. You could trade yen futures if you wanted to, but this put call ratio chart is drawn using the FXY option. So as you can see, it's had a couple of decent buy signals, a couple of decent sell signals, but not every signal has been profitable. But 4 out of 7 or 4 out of 6 on that chart. Now, what about futures? We just got a buy signal in wheat. On the bottom, the put call ratio chart here is drawn using the wheat options that trade on the Chicago Board of Trade. And you can see that where there was a good sell signal about 6 months ago, we now got a very high level buy signal. But there is an ETF that simulates wheat, and it's the symbol for the ETF is WEAT. So even if you don't have a futures account, you can trade those options. And so that's what we're actually doing. We bought those recently. You could go on the board of trade and buy wheat options if you want to as well. It doesn't say you have to buy these, but most people don't have a futures account, but you can still take advantage in many cases of where there is an ETF that simulates the futures. Now this one, not real current, but is a sell signal in hogs. This one, there's no ETF that simulates hogs. There used to be one, but there isn't anymore. So if you wanted to trade this signal, you would actually have to go trade the options, the futures options that trade on the Chicago Mercantile Exchange. All right, so let's move on to the next topic, market breadth. Market breadth is, you can do a couple things with it. Well, first of all, it's just advances minus declines. That's what breadth is, but you can keep a cumulative total, or you can create an oscillator. So that's what we do. Our oscillator, today's oscillator value is equal to 90% of yesterday's oscillator value, plus 10% difference between today's advances minus declines. And we keep two data sets. One is the New York Stock Exchange data, where most people use that for advances and declines. But there are things that are not stocks. So we also have a stocks only one, which basically is every stock that has listed options on it. There's over 6,000 of those now, and so that's a pretty big data set, and comprises everything: large cap, small cap, NASDAQ, and New York, what have you. So this is the oscillator going back 6 years into 2018, and where it's red on there, those are overbought conditions. Where it's green, oversold. And remember, I said, oversold does not mean buy. So typically we're not oversold too often. I mean, that was the pandemic. I'm sorry, that was early 2000. It was December of 2018. That was the pandemic. And then we did go into the bear market. So when we're in the bear market, we got oversold more often. But then we came back out of that. We're not oversold too much again. However, we did get oversold here just around Christmas time this year, right before Christmas, right into middle of January. We got a buy signal as we came out of the oversold condition. That's our buy signal. Then we got overbought, and we just now popped back down, and so we get a new sell signal here. So currently, the breadth oscillators are on sell signal. In fact, it's our only real sell signal from these indicators right now. So that was on February 7th. This is a pretty short-term indicator. It swings back and forth. You can get whipsawed on it, and we do sometimes. But overall, it's still worth trading, because breadth sometimes, can be a sort of a leading indicator. Sometimes it gets ahead of itself even. But the breadth began to deteriorate last week before the market really broke down. There's another thing we look at called cumulative volume breadth, where you take a look at the volume of advancing issues minus the volume of declining issues. And we use this as sort of a confirming or diverging indicator. So when this is making new all-time highs, which it did last year 30 times, S&P should be doing the same, and it did. And in fact, we just had a new all-time high from this cumulative volume breadth on January 30th. We pulled back in the market since then, but odds are that S&P will make a new high as well with that hanging out there. On the other hand, sometimes when you're up near the all-time highs, the market is going higher, but the cumulative volume breadth is starting to diverge lower. That has not happened yet. And, not every bear market starts with a divergence, but the one in 2022 did, and many others have. So if that divergence begins to appear, that would be a real big negative, but that's not the case right now. New highs versus new lows is another thing we look at. This chart is just a snapshot of an Excel file, but we can calculate this for stocks only data, NASDAQ data, or New York data. And New York is what we use for our indicator. And basically when new highs are greater than new lows 2 days in a row and also number more than 100, that's a buy signal. So that was a new buy signal on January 22nd. And you can see going up there, going back a couple of years, there's not that many signals per year. It's just a little bit longer term indicator. And it's, again, has a great track record. So something that we keep a close watch on. Let me just look today, see how it did, how it advances. So today there were more new lows than new highs. So if that persists again tomorrow, that will stop out this buy signal. So it takes 2 days in a row. There was, last time that happened was back there in January when we had new lows being, oh, that was a short signal, new highs being new lows for 2 days in a row. But this is, you know, right now it's still in a buy signal, but it's, I'd say, a little tentative depending on what happens tomorrow. What's with this market and in the trading range like it is, it often just bounces back and, you know, kind of forgets about what happened yesterday. So the last set of indicators I want to look at is VIX and the things having to do with volatility. Spike peaks on the VIX chart are buy signals. The trend of VIX is important. The market generally trends opposite to VIX. And just as a general observation, when VIX gets very low, you often hear people say, oh, well, you should sell your stocks and get ready for a market decline. Well, VIX can stay low for a long time. It's just another overbought condition. Overbought does not mean sell. The trouble happens when VIX begins to rise. So just staying low, that's not a problem. So here's the current VIX chart. You can see we had that huge spike peak back there in August. There's other Bs on there, all spike peaks. We have a trading system built around those. The red ones, again, are successful signals. And there was one here in middle of January, or late January. It spiked up to 2150 and then back down again, or 2250 it was, and then back down again. And that is a spike peak buy signal. So that's in effect for 22 trading days, or if VIX rises up and stops it out. Now, you can see here that VIX had another little spike just, you know, more recently, right there. That was a tariff thing. Today was a CPI, but again, it just barely got over 20 today and then fell back down again. So right now, I would say that in general, VIX is not extremely nervous. Today, it only got up to 17. It's not extremely nervous. It was pretty nervous last August, and even somewhat nervous in December, because that had to do with interest rate by the Fed. But right now, these daily, you know, sell-offs on tariffs or whatever are just not really being taken all that, I would say, fearfully by S&P put traders, which is what you know, creates the price of VIX. So I don't know, that's pretty much just summarizes what I said. But right now, we're still on that buy signal from this indicator. Now, you can't trade VIX, but you can trade the futures and VIX options. VIX options are actually options on the futures. So if we line up the price of the futures in a typical bull market, as we've got over time, the term structure, which is what this is called, will slope upwards. So this is a picture of a bullish stock market when the term structure of the big futures slopes upwards. On the other hand, sometimes this happens. The last time it happened severely was March of 2020, and there's some things you can do when that happens to really make some nice money. It happened briefly last August, but it doesn't happen too often. Here's where we are right now, as of at least this afternoon. VIX was at 1574. The front month future is February, so it was trading at 1670. So 1670 minus 1574 is equal to a premium of 96. In other words, the futures were trading 96 cents over the VIX itself. So you can see that the term structure slopes upwards here. Each longer term one is trading at a higher price than its predecessor, and they're all trading at a pretty healthy premium to VIX. So all of that is bullish. That's what you want to see in a bullish market. You can get the futures prices, by the way, from the CBOE's futures website on a delayed basis. But the CBOE also publishes 6 indices that update all day long. There's a 1-day VIX. Then there's the 9-day VIX. The VIX itself is a 30-day volatility estimate. Then there's a 3-month, a 6-month, and a 1 year. And these again are the prices from this afternoon at 1 o'clock, and you can see they all slope upwards. So again, bullish. That's just a bullish term structure. And there's really no problem here unless the front month rises above the second month. So right now the front month is February, trading at 1670. The second month is March, trading at 1750. That's not really a problem. The last time there was an inversion, as I said, was in August of 2024. So where do we stand with all this? So we had just really one indicator that's on a sell signal. We've got the chart of VIX, which is neutral because it's in that trading range. We've got, so that's neutral here. There is no trend of VIX, so that's neutral also. And these others are in various degrees bullish. We had the VIX spike peak buy signal, the last signal from the McMillan volatility bands. Now, new highs versus new lows, I kind of moved that over a little bit here because that could be stopped at tomorrow and move into the neutral category. The construct, though, we just looked at that was bullish. And the equity put call ratios were kind of trending lower, so that was somewhat bullish too. So overall, it's a little bit bullish. I wouldn't say it's wildly bullish. I've seen it, where everything's over to the left, but it's certainly not wildly bearish either. So, modestly bullish within a volatile trading range, I guess you could say what, that's the overall picture. We're not holding a core position because it is in a trading range, although we will trade individual signals as they come up. Another thing we do, though, is we roll our calls or puts when they get deeply in the money, even if they're spread or not. So you talked earlier about rolling a spread, but if you're just long a SPY option, it gets to be 8 points in the money. To me, that's pretty deep in the money, so I will sell that one and then buy a new one at the strike strikes 8 points higher. And, it takes out a little profit for you and still keeps your upside intact and actually, reduces your downside risk as well. So that's we do that in all of our newsletters pretty constantly. All right, so I mentioned this offer. We're offering now 1 month of each of our top 3 newsletters for $99 total. That's a $728 value. And also the PDFs are on this same URL here. The 3 newsletters I'm speaking of are the daily volume alerts, which I write that every morning. It comes out, there's a market comment, which a lot of people like to read. And all these indicators that we've talked about are included in that. And also, if there is some rumors, takeovers of stocks, it shows up in option volume, that would be in there as well. Then there's the daily strategist, which comes out twice a day, which is just about everything we have. And then the option strategist, which comes out once a week. That's the oldest publication we have here, going all the way back 34 years or so. So you can take these consecutively. I think that would probably be better. Otherwise, you're just going to be flooded with information. You can look up the track records on the website of these newsletters. They've all done pretty well. So, but again, past performance is no guarantee of future results. We also have a YouTube channel, a couple of other newsletters as well. I just want to mention one quick thing of the seasonality. Years ending in 5 have been very good for the market, except for the last 2. 2005 and 2015 were not so good, and people really expected them to be good because of the previous ones. In addition, there's a presidential cycle. The market sort of cycles along with the presidential cycle. Years 1 and 2 not being too good, especially year 2. Then year 3 and 4 do much better. Usually the party that's in power wants to increase the economy and make things look good for the next election. So overall, since 1933, the first year of a presidential cycle has produced a gain of 8%. The second year, only 2%. The third year, though, 14%, and then back to 8%. So what we have right now is we have both the first year of the presidential cycle and a year ending in 5. So there's only been 7 of those in the past. Market's done very well in all of them except the last one. S&P was up 3%. The Dow was down a little bit. So I don't know. I mean, I looked at the end of the year options. They're pretty expensive. I don't think I'd buy them. There might be something just to file away, especially if we break out to the upside. And then one last thing, the January barometers, there's actually 3 of them. The main January barometer, which is the whole month of January, the old saying is, as goes January, so goes the year. Well, that was up. But this short-term indicator here was down. That was so indicating we might fall a little bit earlier in the year before then we gain our footing and go on for a positive finish for the year. So that's it. If you need to contact me, that's our contact information. If you're interested in our money management, visit this website. Our minimum account size is $100,000.